Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Yesterday's action, we saw a very sharp rebound, reversing the previous day's weakness. Now we traded back above the 3,400 level, trading as high as 3,424, with just above Friday's close. While this recovery looked impressive, there's still a lot of work that needs to be done before we'll be out of the woods and put a bottom in. There remains a substantial amount of downside risk, and I'm expecting to see a potential retest of Tuesday's low before we get out of this pattern. Now, a higher close today will change things a little bit. I'll go through all the details here in a minute in the technical section. As we come into Thursday's session, we're going to see the release of the unemployment claims. They're expected to show 850,000 increase. If it comes in greater than that, then that will be negative. The number I keep telling you to watch is that continuing claims. It was at 13.2 last week. If it comes in lower than that, it will be bullish. If it comes in higher, it will have a negative impact on market activity today. As I've been suggesting over the past several weeks, I don't think the metrics out of the economy are going to come in as clean and better than expected like we saw in August, and I think these numbers are going to start to present some challenges to the markets. The other element that will be out today is producer price index. I don't see this having any material effect on the markets today unless it were to come in much higher than expected, and that's not likely. The volatility that we've seen over the last couple of days is likely to continue, but I am seeing a contraction of the 3-day volatility indicator. It's back down to around 78. It was at 120 on Tuesday. So we are seeing some dampening of the volatility. Possibly we're going to see some stability come into the markets as volume is likely to slow down and the range continue to contract for the next several days. There's not a lot of material things going to affect the markets, so let's go ahead and take a look at the charts and see what they're telling us for Thursday. Reviewing the WaveTech database, once again we're seeing some moderate liquidation as the short-term database is down to a bullish percent of 16.48. It looks like it should start to stabilize here. It could go a little bit lower. Because of the extreme liquidation that we saw, this sets up another scenario in watching the database. If it remains under 26% for the next week, that will tell us that we're going to see more downside risk. As I mentioned in the opening comments, there still appears to be plenty of downside risk to retest Tuesday's low. There might even be some lower numbers. I'll go through that in the technical section here in a minute. But the database itself, if it stays below under 26% on the daily database, this is going to be negative, and there won't be a reversal in the trends until we see traction back above 42%. Now, I've been talking about this for several days. My expectation is that we will see at least 4 to 6 weeks of consolidation with a bias to the downside now. This will set the tone for ultimately a recycling of the short-term database and possibly some minor liquidation in the intermediate models. But looking forward on the short-term database, this is going to be critical to see a move back above 26%. I wouldn't expect to see that happen for at least 2 weeks. As we review the S&P futures, we did see a move back above the 40-day moving average, which was significant from the pattern standpoint. As it closed at 33.95, the 40-day moving average is 33.46, so it's quite a bit below where we closed. That is a key number on the charts right now, and this will also be a number to watch over the next couple days. If we move below the 33.46 number, that will be the trigger for a retest of the 32.95 lows that we printed on Tuesday. As we look at yesterday's high, we did print up to 34.24. Overnight we did trade up to 34.1150. The key pivot number will be this 34.25 level. It's slightly above yesterday's high, but that is R1. If we got above that, then that would suggest a further advance toward the 34.59 levels. However, there is some major resistance at the 21-day moving average at 34.27 and also at the 34.60 level. This is going to represent a cap on this market. The PPM1 is declining at a minus 0.22 right at trend levels, suggesting that 34.60 will be a major resistance point. We're likely to react off of that level. If we don't see a move over the 34.25 level early in the session today, we're likely to see a rejection and a challenge moving back toward the lows that we've seen overnight in the futures at 34.71. As we review the daily S&P cash, the key number on the upside will be 34.26, yesterday's high 34.77. That is the 21 period moving average. If it gets above that, then the next level is 34.69. And on the cash, we're not seeing the same acceleration on the downside on PPM1 that we're seeing on the futures, but the key number will be very similar to around 34.60 to 34.63 on the upside. It's not likely we'll see that follow through today. The expectation is if we don't get above 34.17 early in the session, that we will see a decline to test the overnight lows at the 33.71 level. If we penetrate that level, then we're likely to go down to test that 40-day moving average. As we look at the market grid, if we can get above 34.17, we could trade up to 34.38. That would be a trigger point above both the 21 period moving average and yesterday's high. But there's going to be a ton of resistance between the R1 number and yesterday's high, 34.17, 34.24. If we close lower, then we're likely to go back and test that 40 period moving average, which is currently at the 33.52 level on the cash markets. As I covered in the live stream yesterday, S3 33.30 has been the low for the week so far, and R1 is 34.56, goes right into that resistance zone that I talked about. We could see some follow through today, but I think it's very unlikely that we're going to see this number, but we'll look for the triggers that I just talked about on the daily. It looks like the potential for this week on an extreme on the upside is probably 34.56, and we've already seen an S3 print 33.30. If we do see that close over 34.17, then we're likely to see a move toward that 34.56, 34.60 level, but that will be substantial resistance at that point. The other thing I want to mention as I review the S&P weekly is the position of the PPMs. Each one of these, PPM1 is right on its second derivative. PPM2 is right on its first derivative. Looks like it might penetrate. PPM3 has already penetrated its first derivative. It tells us that we're likely to see this momentum bleed off even further next week. And I'll be able to zero in on this better for Friday's close, what the trigger points are likely to be. But this is where I was talking about there's still some potential downside risk. If certain things happen, we could see the market move down to the 21-week moving average, which would be 31.56. The probabilities right now for that to happen are only about 20%. We'll have to see how the pattern sets up as we come into Friday's close. We're definitely at the point where we could see a further contraction on these indexes before we see a bottom. The only thing that's going to hold us up right now is going to be the 10-week moving average, which has a 0.81 PPM1, which suggests the 33.35 level should hold, which is also the low of the week, 33.29. So we won't see the challenge of any of these numbers until we get into next week's activity. The next market that I'll cover is gold. We continue to be in a sideways range. We did manage to close above the 10-day moving average, 1951, suggesting a slight bias to the upside, but there is substantial resistance now between the 1958, 1966 level. RXT for today is 1973. Overnight we printed 1959, so we printed right at R2, and the support 1 is 1936. The high-low so far has been fairly narrow, 1950 with a high of 1959. My expectation is we're going to continue in this slightly sideways range, only now we're going to start to trade with a slight upward bias, and you can see ppm1 is starting to expand a little bit. It's at 0.10. ppm2 is trying to cut through its first and second derivative. ppm3 is taking out the first derivative. So this is a sign that we're trying to make a turn on this market. There's still not enough momentum to move this out. We're going to need to close above 1966 to get the momentum to kick in on ppm2 and 3. We still need the prices to move higher to get this market moving. This is the end of the video. Thank you so much for watching. Thank you for participating in the live stream yesterday. We'll talk to you tomorrow night.